All right, cash flow machinists. So now is the time to start talking about those crazy weeks that happen like 4 times a year. And that's when a company reports its earnings. So in theory, nobody really knows what a company is going to report. And so there's all this pent up energy within a company's report that makes the stock move. So here are the dynamics. So there's the people on CNBC talking about the move. There's the company that knows what the move is. There's the analysts that think they know what the move is by analyzing the company. Then there's the analysts that think they know what it is because they listen to the company's guidance. Then there's all the investors who think they know more than the analysts. And so they have what's called a whisper number. Like if the company's expected to make 30 cents a share, the whisper number might be 32 cents a share. And then there's all those expectations around all of those things, which makes the stock move up or down. So sometimes if a stock's supposed to make 30 cents a share and the whisper is 32 cents a share and they only make 31, well, they still beat what the average analyst estimates were. But at the end of the day, they didn't beat the whisper number, and so therefore the stock goes down a lot. You know, sometimes you'll see a stock go down 10 or 15% in a day. So listen, we're conservative here, right? I mean, I don't care what you say about how much our returns are because they're really great. But at the end of the day, we want to save our money. Protecting your capital is the most important thing. Because if you don't protect your capital, you got nothing to trade with. So we want to be out of these markets, or at least mitigate the risk in these markets during those 4 weeks a year. So we don't want to be in stocks when the market's tanking, if we can help it, or we want to protect ourselves when the market's tanking. And we don't want to be exposed if a stock is going into numbers. I don't care how smart we think we are. I don't care how much we think people are watching Netflix. There's that expectation, there's the whisper number, there's what the actual number is, and then there's the conference call. I forgot to mention that. So conference call is on the day of the numbers. They come out and they say, yeah, we made 31 cents. And then they say, but we expect the end of the year to be light. Well, okay, it was great that they blew numbers away, but at the end of the year, if they're expecting their numbers to be light, remember stocks trade on future expectations, then people sell off the stock. So really, the bottom line is my crystal ball is always in the shop. I never know if the stock is going to go up or going to go down. That's why I use the cash flow machine to create income for myself, create protection for myself, and I try to be out of those 4 weeks a year where something bad could happen. Something good could happen too, and I'm going to miss out. Oh well, but I don't want to lose my money. So I want to be very, very conservative during those 4 weeks. So taking a look at the stock in front of you right now, that's Netflix, and you can look at it, and you'll see these little arrows down at the bottom that shows you when the earnings per share are, right? See the blue line going up there? Their earnings releases. And so if you look at those candles, they're usually fairly significant around those days or those weeks. So what we want to do is identify when the company is coming out with numbers. And Netflix right now is expecting numbers in October, so we're fine because we're just in August, so we have several months to deal with Netflix's gyrations. We don't really care too much what they do. All we care about is the juice, really. The stock stays the same, goes a little bit higher. That's ideally what we want. So let's just take a look, starting on the left side. Look at this blue line. That was a significant drop for Netflix on that day. Like it's called a gap down, and gap downs are pretty big signs that there's a lot of selling. All right, so look at that. That was a gap down. Then we had a gap up, and then it came back down on that day. So there's a lot of volatility. Notice how little these candles are. A little bit of movement. These are candles from high, low, high to low, high to low, high to low. See how little they are going into numbers? And then all of a sudden, boom. Big number, big candle, which means there's a lot of volatility. So, a couple things we can learn from that. Going into the numbers, because there's huge amounts of volatility, and remember, volatility helps determine the juice in an option, the time premium, and the higher the volatility, the higher the time premium. Well, going into those numbers, you're going to get some volatility. So it's going to be awfully tempting for you to want to get involved because that juice is going to be so good going into the numbers. Don't be seduced, okay? We want to make sure that we're not seduced by those big numbers going into earnings because you have these big gap downs like you had on this particular day. Where look at the high. Look at the close the day before. The high is 366.50. Look at the low of this next day where they had numbers, 320. That stock was down 60 points, right? Sorry, 46 points. That's pretty significant. You don't want to be caught in that because it's going to take you a long time to make up for that. So we're either going to be out on those weeks, but that may create some tax problems if you're in a non-IRA or non-retirement account, or you're going to want to be way deep in the money, and that's going to protect yourself all the way down until you get to that 340. So we'll talk about those strategies, but the goal is to be out on those weeks, and I'm going to give you a system for what you do during those weeks. But I want you to understand that those weeks move significantly. Let's keep going. So that was a big move. Let's go to the next earnings per share. Look at this one. That was a pretty big move. Not right on the day, right? But right after it, look at this big candle on high volume, okay? So that was a big move. The high to low was, 25 points, right? The low was 325, the high was 349. Big move. Like, you don't want to be in there if you don't have to be. It's because it's going to freak you out. All right, this next one, the move was from 47 down to 425, another 25 points. Big move. And then this last one, what we have here, look at that move, 535 all the way down to 504. It's another 20 points on the move. But if you were involved in all of these weeks, like that's a pretty hairy situation. That stock went from a top of 575.37 to right after the numbers was trading at 484. Like, that's 100 points, guys. You don't want to be sitting through 100 points. That should scare the crap out of you. It scares me. So we don't want to be in the stock during those weeks. Now, we were in the stock because we have a system that tells you how deep in the money to sell. And let me tell you, it's significant. And we made money this week. We didn't make as much as we always make, but we made money this week. So this shows you, like I've been telling you since we've met, you can always make money if you put enough protection in for yourself and optimize for juice. All right, let me look at a couple more for you and then you'll get the idea. I want you to do some homework on your stock and maybe 4 other ones as well so that you can get an idea of how much a stock will move during those weeks so you can feel the pain before you actually put your money at risk. I don't want you to lose money, guys. It's the main thing here. We want to keep making money because that's the key to compounding. And we're going to talk about psychology of wanting to swing for the fences because this is going to be boring. You're going to have to stay in the system. So let's go all the way to the left. You'll see Apple here. There's a gap up, okay? The low was 199 the day before and it went up to 215. That's a pretty big move. That's 7.5%. All right, the next one in this blue line here is, let's see if I can get it. The close there is 207.31 is the low and the high is 221. That's a 14-point move. That's a pretty good move. We don't want to be in it. This one wasn't much move at all, right? But okay, that's just one aberration. This one, look at all the movement right around that earnings per share date, right? You had gaps down and you had gaps up and chases and volatility. You don't want to be in that if you can help it. All right, looking at this one, pretty much a non-event. And then this final one here, look at the volatility on that one. It had a huge gap up. The close here on earnings day was, well, the low was 375. But look at just 2 days later, it went to a high of 446, 75-point move. So you don't want to be in that. Even if you're right, you don't want to be in it because you're going to be losing money on the call. It's going to feel like you're losing money. You're still making money on the juice, but you're going to be losing money on the call. So you don't want to be in on these weeks, guys. Just, I don't know how much more to pound that into your head. 4 weeks a year, you're out or you're very, very, very protected. And you've got to be careful. That's why we don't trade 14 different stocks, because to know all the different numbers and what they're expected and when they're coming out and all that stuff, you don't really need all that. You need 1, maybe 2 stocks on the outside. You need one really good one that you know well. You know when their numbers are. You know who the CEO is. You're happy with the company. It's trending up. You know it's doing all the right things. You start getting involved in diversifying and all this other crazy stuff, you're going to need to know too much, and it's going to mess up your system. All right, one more stock. Let's do Zoom. All right. Now this is a new issue, so you're not going to see a lot of data on Zoom. But look at this. Let's just look at it from lower left to upper right. Look at how smooth it was, trading in a nice little range for a long time, and then boom, it broke out. This is an ideal stock. Really, it is. But let's look at those earnings numbers. And I'm going to draw your attention to a couple of things that I see. Earnings were 400%. Earnings were 300%. So they're growing huge, right? Grew from 2 cents to 8 cents. Earnings were 800%. So this thing is building cause to go higher. Earnings 275. This is like almost a textbook stock, guys. Earnings were 567, right? Earnings are now due in a month. So let's look at the numbers, right? When you get things that are moving 300%, it's percentage-wise a big move. Like just look at this candle this day. Well, 96.50, and then 3 days later it was at 76 bucks. That's a 20-point move. That's like a 40% move, guys. Right? You got to watch out for that. Sorry, it's like a 25% move. All right, I'm a hyperbolic here because I want you to learn it, right? You don't want to be in that week. Because if it goes against you, you're not deep enough in the money, you're going to be hurt. I don't want you to be hurt. Look at this gap down. It went from 75.84 to looks like 62. That's a 13-point move. That's almost 20%. 275% move on the earnings. Look at that big candle. Very volatile, right? And then look what happened after. Lots of volatility. And then finally, look at this one. Couple days before earnings, this thing was 149, and then after it hit earnings, the thing was just within a couple days was already up at $222. Well, that's good if you just owned the calls, and we don't own calls because that's what the risky people do. They would have given us a lot of juice, so we would probably made some good money going into that, but we want to be careful going into numbers. All right, I hope I've hammered that into your brain, and there's only one test question, and I'm not going to even type it up. Should you hold a stock and an option going into numbers? The answer is no. You have to protect yourself going into numbers. Doesn't mean you need to sell it, but it does mean you need to protect yourself. That's the trick question to the answer. Trick answer to the question, unless you're on Jeopardy. All right, so we want to just watch out what those earnings weeks are, and when we want to be out on those weeks. Okay? I hope you got it, and I hope you never make the mistake, because there will be 1 time, 2 times, 3 times where you might do well, but there might be that 4th time where it wipes out everything that you've gained, and we don't want that. All right, let's just be conservative, be boring, hit our singles, stay out during those nasty weeks, and get back in the week after, and we can go back to the cash flow machine making us money.
Hey, just a quick update to why you don't want to sit through earnings without being protected. Look, and there are some things in this course that I err on the conservative side for, because I don't want you to get hurt. Now, you're going to lose money some days. You're going to lose money some weeks. But these weeks that we can protect ourselves, that we can prevent ourselves from getting hammered, those are the important weeks. And I want to just take a moment real time to highlight a couple of the stocks that have just gone through numbers. And they just got hammered, right? And if you weren't protected, you could be decimating your account. And, the best way to make money is to not lose money sometimes, right? And so we have 4 chances during the year to protect ourselves, and those are earnings weeks. So why not take those chances and protect yourself? You don't need to make money all the time. Let me give you an example. All right, so here's our first example. It's Netflix. So you can see this is an hourly chart. And you can see that if you go back, let's say a week or so to the 20, maybe 10 days or so, the 20th, you could see that big gap down. That's the day after they had reported numbers. They reported numbers after hours on that market night, the 19th. And then on the 20th, the stock just got hammered. Actually, it was, getting hammered after hours. If you'd have been cruising along, selling your calls against Netflix and not caring that earnings came up and you had the 350s, right? Or even if you were protected down to the 330s, this stock opened up at 230 or 225 or something like that morning. And it just kept going down. Look at that chart, right? Like, did you want to be decimating your account by 100 points that morning? I don't think so. And so not that you could predict when a stock is going to go down $120 on an open, because you can't. But you can't even predict that it reported. Like, it reported a loss of subscribers, and they hate their customers, so they were going to start charging for every log on, something. What doesn't really matter what the reason is. Even if the numbers were good, and I'm going to show you a stock that the numbers were phenomenal in a second, stocks still can make these crazy moves. So you'd rather be out of a stock wishing you were in than in a stock wishing you were out. Okay, the next one we're going to look at here is Tesla. Now, Tesla's one that we're all in right now. I don't know when you're watching this recording, but most of us in the mastermind group are in this stock, and we're doing really well with it. Now, you can take a look at Tesla back around the same time that Netflix reported. It was the next day on the 21st. And it just crushed numbers. Like, it blew away earnings. It blew away sales. It blew away expected deliveries. Like, everything was great. And the stock gapped way up. It went up from, 970 or something like that to 1080. It hit a high of 1080. It made this little spinning top candle, and then the wheels came off. Why? Who knows? The market doesn't really matter why. Like, we don't know why. More sellers than buyers is why. But you've got to protect yourself. Like, even if the best stocks out there with the best numbers still do this crazy stuff. So look at this thing. It went from 1080, this is an hourly chart. And then all of a sudden, look what happened 2 or 3 days later. It was at 1,000. Everything was fine. Look at that. It had a whole day or two right around $1,000. And I even thought, well, looks like the stock is solidifying at $1,000. Maybe I'll even consider rolling up. It's a red market. We don't want to be rolling up in a red market. It's certainly something that you consider. You're like, well, numbers were only a couple of days ago. And then look what happened to the stock. It went from 1,000 to 950 to 900 to 850, all the way down to 830. So let's look at the breadth of that move. 1080 at the top, all the way down to 830. What's that, like 25%? Like, can you handle a 25% move? It's really tough, especially if you check your account all the time, which you really shouldn't. But the point here is you got to protect. And this protection would have not really helped you during numbers, but it would have helped you after numbers, right? So you just never know. Even sometimes 3 days after numbers, there's still some processing of those reports. The last one is something that just came out this morning, and that's Expedia. They reported a 1 cent miss on earnings, which is really no big deal, and they reported in line on sales. And everybody's going back to work and back to traveling and back to, flying in airplanes and cruises and all that stuff. You would think that fundamentally this stock would go up. But you know what? We ignore fundamentals, right? Once you're in the stock, who cares about the fundamentals, as I've already shown you? So look at Expedia, right? Watch this. This is this morning, all the way on the right side of the chart. The stock opened yesterday or closed yesterday at 175. And everybody thought, well, Expedia is doing great. And even after hours, they were doing great. They were up like another $3 after hours. They went to like 177. And look what happened this morning. The stock opened down at 169 and it traded all the way down to 152. That's just in the first hour this morning, right? So that's a 12% move just from yesterday's close. From yesterday's high, it's like a 15% move. We don't need to be exposing ourselves to 15% risk. There's just no reason. Anyway, I'm tacking this on to that other part of the video because I think it's so important that you protect your risk on earnings days. And even you might even see a couple days after earnings, things can still go awry. So just be careful around these earnings times. These are the times that you can prevent it. So why not take the chance to do it? Hi, Mark Yegge here, wealth architect and author of this book on my covered call investing system called the Cash Flow Machine. Listen, what you just saw is just one part of creating reliable income of 2 to 4% a month from the stock market. But if it were that easy, then everyone would do it, right? If you want to learn how I create investment income the right way, then you need to learn and have a system with rules and what-if strategies so that you can learn what I do when the market goes against me, what I do when the stock goes against me, how to adjust my trade so that it's always in a winning position, how much to risk, how to build a multi-million-dollar portfolio that creates income of $10,000, $20,000, or $30,000 a month in semi-passive income. And best of all, the whole cash flow machine system takes less than an hour a week to implement. Just go to cashflowmachine.io to learn more or click this link for more videos, masterclasses, and free resources. See you there.